I think community bankers and community development bankers can help. We are intensely local and truly relationship focused. We are small organizations with limited resources as well as limited resources for error. We are regulated. Some CDFI banks have been able to engage in some alternative developments to payday loans. However, we have not as a group or individually cracked the code that enables us to not only do more, but ideally to move residents of our communities and all of our customers away from paydays into savings accounts and things that really are building assets. And we have certainly not figured out how to do it profitably. And what I also want to make sure that we don't wind up having programs that are not sustainable over the long haul, are simply a reaction to political and public pressure, and or are a charitable act, because those are not going to be sustainable. Community development banks could be well positioned to meet the particular needs of these customers. Not only are we relationship driven, we're embedded in the community. We know our congresspeople, we know our church leaders, we know, they know us. This is our turf and our neighborhoods. Decisions are made locally. You have access to the highest people in the institutions. You call up and you want the president or the chairman of the board and you get him because he's there or her. You want to know where a credit decision is being made, it's being made there. It's not being made in a faraway state. It's not only formatted lending. But there are things that we would need as community development banks to do more. But actually before that, let me give you two examples of what the Central Bank of Kansas does, which is not really an antidote to payday lending, but is an attempt to try and get customers of theirs into what they would call savings, and we would call savings. They offer a certificate of deposit loan that they feel competes with payday lending products. The customer takes out a loan and immediately receives a certificate of deposit, which serves as collateral for the loan. And when the borrower pays the loan back, and they've established credit and now are bankable. There's a wonderful bank in Milwaukee, Legacy Bank. Actually, it was started by women. And they connect checking account customers who have bad credit to financial management classes. And they are able to borrow an emergency loan from the organization that sets it, and the bank gets paid back. Legacy then Legacy's whole focus is on making low-income customers good, solid, profitable customers. CDFI banks, one of the problems with the CDFI banks is that, no, that's not mine. CDFI banks, oh, it is, sorry. Well, now I apologize to you.
Don't worry about it. It happens.
I'm sure it was a grandchild. The CDFI banks the CDFI banks have to declare, in order to be certified by the Treasury, you have to declare that you are mission-oriented, which means that most community bankers who really do all this are not going to say that. They see themselves as bankers and profit people. The fact that 60% of their loans and everything they actually do fits into what we would call a CDFI doesn't matter. And one of the reasons then is we have over 7,000 community banks nationwide, and it's interesting to note that only 8% of those certified are banks. 67% are nonprofit loan funds. 19% are credit unions. 3% are venture loan funds, and another 3% are depository holding companies. The CDFI fund has been helpful with the grant programs to banks, as well as helping many banks get established in areas that would not otherwise be banked. There is ShoreBank had a community development bank in Cleveland, which is now a branch of our bank. But other things that would be helpful are CDFI banks should receive favorable consideration for receiving government deposits and loan participations. This came out quite clearly when we talked to people in the Katrina area. What they really needed was not deposits, but they needed loans. They had a lot of money, but there was no way to help those banks in an organized fashion, whereas you could have identified them as CDFI banks, certified them, and taken the class of those who pass the 60% test. We need to deal with loan loss reserves if we're going to expect and task community development financial institutions banks to support these specialized lending programs. We need encouragement from bank regulators, the others as well as the FDIC, in the form of examiners who understand and support banks' roles in providing alternatives to payday loans. The easy money is for financial education, and I guess I pray that we don't wind up recommending financial education. Of course it's needed, but everybody would like to send you to a class instead of really doing the hard thing. Regulating away payday lending will not eliminate the unique financial needs of individuals with low assets and poor credit, needs that high interest short-term check cashers offer easily, and it is at a cost, and people do know that. They just can't deal with it because they need the money, or we do live in a society of wants. Wherever you go, if you can't afford the plasma TV, I'll help you get one. If you can't afford the house, I'll help you get one. If you want a new fur coat, I'll help you get one. Whatever it is, we live in that kind of world, and we have to acknowledge that. What must be part of a regulatory package to limit payday lending are incentives to help mainstream financial institutions and credit unions. Community development banks are mainstream, and they do offer products to these companies and customers, and they need to be tasked to offer more. Bottom line, it's not easy. There are no simple answers. It will take the will of government to encourage, incentivize, because money does talk. If these banks are able to achieve profitability through loans, deposits, and other ways that the government helps, through the regulators, everyone has to be involved. We do not want to look back a few years from now and see another mess like we now have with some of subprime lenders and the institutions that funded them. It was a way was figured out because we all promoted home ownership. Home ownership was going to be the answer to everything, and we wanted minorities to have own homes. We wanted poor people to have homes, and whether it was the Democrats, the Republicans, the governors, the states, we all believed in home ownership. And now we have a pretty mess and a lot of people who thought that they were getting the American dream and now realize that it was a sham. And we can't do that on quick loans. We've got to figure out how to look at the source. We understand the problem.
Thank you very much for your testimony, Ms. Grossman. And I'm going to